Hi, I'm Jeff Banks from MW Lomax, and this is the Banks Report.
The Banks Report, a commentary by noted property and business tax consultant Jeff Banks. Jeff is not your ordinary accountant and speaks in words and terms that you understand.
In my practice, I help people who are working hard and using property and self-employment to help them reach their financial goals. Following on from last week where we talked about repairs versus improvements, this week I want to clear up some misapprehensions around deductions for depreciation. Depreciation is effectively a tax deduction for the writing off of the cost of an asset over its useful life. You will sometimes hear a term like non-cash deduction, which simply means that you will have paid for an asset to which depreciation deductions apply in another year, but get the benefit in the form of a tax deduction in the current one. The ATO have lots of statistical information around the useful life of various types of assets and have provided schedules that allow accountants to easily ascertain what deduction you may be entitled to that seeks to quantify normal wear and tear. For those of us seeking to claim a deduction for the building costs of investment properties, the acquiring of a depreciation report from a quantity surveyor will become appropriate evidence for claiming of a depreciation deduction. A quantity surveyor's report is a one-off cost, which is also deductible, and there are a number of very reputable quantity surveyors who provide this service. For those of us purchasing a brand new property, the developer should provide you with a relevant cost schedule that will be same as a depreciation report. The question becomes, at what age or at what point in the life of a property does depreciation become irrelevant, because the age and the remaining useful life based on the ATO statistics mean the cost of acquiring a depreciation report does not justify the outlay. This is always a vexed question, given any property that is more than 15 years old, which has not been substantially renovated in the course of its history, is probably too old to justify the expenditure of a quantity surveyor's report. On the other hand, a property that has been substantially renovated by someone other than its present owner, who should have the appropriate records at their fingertips, may be well worth the investment. The other thing that the budding entrepreneur tends to forget is that depreciation reduces our cost base for capital gains tax purposes, and that the claiming of a deduction in the short term will mean in the longer term, when we sell the property, we will report a higher capital gain. That certainly should not deter a property investor from acquiring a depreciation report. As I have noted at times, capital gains tax is effectively your friend when it comes to the limiting of liability of taxation on transactions. But that's the subject for another day.
The Banks Report is created by Jeff Banks of MW Lomax, a specialist financial services firm offering strategic advice and services you need in property and business, including accounting, taxation, finance, financial planning, risk insurance, superannuation, and business advisory.